Jason Trost, welcome back to the Business of Betting podcast.
Thanks very much for having me back.
So a lot going on in the world, and we'll get to some betting topics pretty quickly here. Just before we do, anything impactful in your world? Obviously, many things going on, but anything that you're taking from this time that you'll carry forward? Is there any aspects of what the pandemic is doing in this current environment that are useful for you in terms of positives?
Well, I never knew people wanted to bet in table tennis, so that's something new I learned from this pandemic. I didn't even know betting on table tennis was a thing before this. I think a lot of the positives are more on the personal side than the work side, but a lot of the personal takeaways are more, taking less things for granted, taking, the day-to-day life that has been upended in so many different ways. I think I'm going to certainly try to take less things for granted. I think, from the business perspective, I think capital efficiency was always a big deal even before the crisis, but the crisis kind of brings that into more focus. How can you leverage technology? How can you do more with less? Those kind of issues become a lot more important. And I think, the technical nature of our company has put us in good position for that. But even, I probably considered ourselves certainly one of the best in the industry. But even after this crisis, we have found lots of areas of improvement. So, we can always keep making things more efficient and faster and cheaper and better. And so the crisis on the business side, I think, will really push people to be a lot more efficient with capital and people.
What about on the entrepreneurship side? Have you found that certain people or groups have stepped up or are forced to step up? I know there's a lot of unique sports content going on that people probably haven't heard of, and you mentioned it before, but Nicaragua and Belarus and these type of places get a lot of mentions. Have your team had to take on that role?
Yes, of course we have. But fortunately, because we've always been kind of a scrappy kind of company, it kind of came naturally to us. But yeah, in a short time, we added all these different sports, including the ones you mentioned. I didn't even, I'm pretty sure I couldn't even place Belarus on a map, let alone knew that they had a football league. But yes, we had to get together and add all that stuff. We've added international horse racing. We've added greyhounds. We've added table tennis. Esports, I think we're up to 4 or 5 different leagues or different esports sports, I guess you might call them. So we've done a pretty good job, I think, of adapting to the new world.
Does that content stay or stand the test of time, or is that something that gets pushed back on roadmaps and eventually might drop back off?
No, I think most of it will stay. The one area I'm a little bit squidgy on is greyhounds. It's sort of I don't know. It's kind of I feel a little bit uncomfortable with the idea of the fact that you need so many different dogs for it. So I'm a little bit on the fence about how I feel about greyhounds, but certainly esports. I've wanted to do esports forever, so that's definitely going to stay. Table tennis, why not? If we have if it's automated and it's easy to price, why not? But I think most of it will stay.
And what about overall volume? Obviously, more people at home, more people on their devices potentially all day, as opposed to the top tier content or any real content being available. Has that been counterbalanced at all, or is it mainly a negative?
No, it's pretty grim. I don't have the exact number, but I would say we're running around 20% normal volume, something around those order of magnitude. So while we do have more events to kind of make up for it, it's a fraction of what it used to be, a small fraction of what it used to be.
Do you have any sense of what a, in quotation marks, bounce back looks like, or once we start getting a steady stream of sports coming back, hopefully by middle of this calendar year?
Well, I think it's going to come in drips and drabs. It looks like the Bundesliga is going to come back first. British horse racing is trying really hard to come back in May, so it might not happen in May, but it looks like there's a lot of momentum to try to get that live at least in June for like the Epsom Derby, for example. So I don't know. I think it's going to be a league here, a league there, and it's going to slowly come back on board. I don't think it's going to be, July 1st and everything's going to be back to normal. I think some countries are going to be faster to rebound for a few different reasons, some of which I don't really understand. Germany has done a really good job managing the pandemic, and so it looks like Bundesliga is first, and the UK is one of the worst. So it looks like Premier League will be one of the later ones to come back online.
So last time we spoke, and I encourage everyone to go back and have a listen, and you'll probably realize some obvious topics that we're not covering because we chatted about those previously. But The US was a topic we touched on, and certainly now it's becoming more obvious for your business. Just tell us about the period of time since we last spoke, how much it's shifted in terms of your focus, and obviously you being in LA and being in the US market and seeing what's happening. Has that become a primary or a top priority for you guys?
Yeah, it has. I mean, I know way more than I ever wanted to know about regulations of sports betting in the U.S. And the terrible tragedy of it is that we're going to launch in two states, Indiana and Colorado, and even they're not the same. So like Indiana has its own laws and its own technical certification. Colorado has its own laws and its own technical certification. So the United States as a marketplace is actually a very frustrating, backwards, slow-moving, poorly designed marketplace to enter into. But we think obviously the United States is a big country and a lot of people want to bet. From an economic perspective, it's a no-brainer, but from a logistics point of view, it's the most by far complicated regulatory regime I've ever come across.
So just give us an insight into that. Do you have to build everything twice in general terms, or is it just a process-driven and a detail-orientated process that just drives you nuts?
Both a little bit. To give you an example, like there's a standard called GLI 33, and I don't know how many states have adopted it, but I would say like 5 states have adopted it, of which one is which is Indiana. Colorado has not adopted GLI 33. So in GLI 33, it calls for the format to include a Y and a date range, and if you don't have the Y and the date range in this particular report, you don't pass the audit. So you have to go to your back office and make a report that, exports things in a very specific format. So imagine that times 1,000, and that's what we've been dealing with.
Yikes!
Last few months. It's to be honest with you, it's really, really bad. And also the United States did a really poor job. And when I say the United States, you can kind of think about each state being its own country because each state is coming about it a very different way. The states did a very poor job of looking at the UK as an example. And so they have very, very, very hodgepodge, poorly thought out regulation, and we have to jump through all these hoops. Like half my staff has to get fingerprinted, background checks, just insane amount of due diligence, which is completely over engineered. So it's been a very painful process, but we're getting close to the end.
So what's the rhyme or reason behind Colorado and Indiana specifically, and also just in terms of product offerings? I'm sure you deliberated through what was the optimal way and most efficient way to access both of those markets.
Yeah, it was more opportunistic than anything. I mean, it was just right price, right time. We didn't really care which state we launched into. We came close to pulling the trigger on New Jersey, but didn't get a deal in place in New Jersey. So there's not a rhyme or reason for Colorado or Indiana. Just we ended up doing a deal with Full House Resorts, which is a casino group, and it's just right place, right time, right price, and we decided to go for it.
And are they states that you've identified and think you can have a long-term presence in? Obviously, you would hope that's the case, but just in terms of the ability for Smarkets to prosper in those two states, is it a very positive outlook? Because I know there's some states with a long tail of operators that have a very small market share, and it's a challenging approach, but it may be a more strategic play.
No, I mean, I might be naive thinking about it like this, but in the UK, UK is our home market. There's, I don't know, 300-400 different bookmakers we're competing against. So, when you say New Jersey is a crowded marketplace, there's 20 operators in New Jersey. So it still feels very uncrowded to me, even though that might be a misguided perspective. But our goal is to be number one in sports betting in every state. And so to me, Colorado and Indiana are more test markets rather than strategic long-term interests. So we definitely want to be in every state for the American audience.
So I got to ask you about political betting. And recently in West Virginia, there was a moment in time where it was probably possible, it seems like, albeit it was a few minutes or barely an hour. From your perspective, obviously with Smarkets and politics being within that portfolio, where would politics fit on a volume perspective if we could project here in the US that it was possible and we had a few more states open up? Would it be something that would fit into the top 4 or 5 in terms of volume?
No, absolutely not. It's also something, it might be a little bit too much esoteric law, but basically political bets falls under the purview of the CFTC, which is a federal regulatory body that regulates commodities and futures trading. That's what it stands for, Commodities and Futures Trading Commission. And so the reason West Virginia got in hot water is because they went against the purview of a federal agency, which is why they had to backtrack. So the complicated part in the United States, first of all, is not doing political betting. It's getting the right license to do it, and that requires going through the CFTC. The states are not authorized to have trading on politics. The second issue is even if they do, it's still pretty small potatoes. In the UK, we're probably the number one political betting website, and it's a fraction of the volume. So the problem with politics is a few things. One, it's kind of a niche thing still. Like not that many people follow politics compared to sports in general, but the amount of people that want to bet on politics in proportion to sports is smaller. The other problem with politics is there aren't regular events. Sports have that really nice property of like the game's in 2 hours and it's over in 2 hours and you get your money if you win. And in politics, we have long running markets, which kind of, we're trying to create more short running markets, but it's really difficult. We had some markets on like how long Trump's going to speak during his briefing, those kinds of things. But the meaty markets in politics are like who's going to be the next president, what's going to happen with Brexit, those kinds of things. Those things settle once every 4, 5, 6, 7, 8, 10 months, and they just don't happen often enough to create enough betting volume to make it interesting from a betting perspective. But I think it's super. I mean, I love political betting. I mean, it's one of the main reasons I founded the company. If you go to smarkets.com, you can see some really cool graphs. One of the graphs I've been watching a lot is, Trump versus Biden, which is really interesting. So I think it's one of the best ways to kind of get a real-time view of the chance of something happening. But unfortunately, from a revenue economic point of view, it's still pretty small part of our business.
I was on there earlier today looking at the Democratic vice president nominee markets. I don't even think it's an active market. I think you just had some graphs on there that were available, and or maybe it's because I'm here in the US and it's blocked, but it was interesting because I was having a discussion with someone about it, and I was trying to think of how I can prove to them, like even when we're talking about the Democratic nominee, and I said to someone that Cuomo was a 20 to 1 chance or something like that, and they said, what are you talking about? He's not even in the race. There's no way he's a 20 to 1 chance. He must be a 1,000,000 to 1 chance. And I was sort of like, I wish I could bet with those people that don't necessarily have all that information in front of them. But in terms of the utility outside of the betting sphere, these types of prediction markets can help with guiding things. Even with Biden and Bernie, it felt like Bernie was miles ahead of everyone, and then I don't know if it was South Carolina or somewhere like that sort of tipped things. But these prediction markets can have further utility.
Yeah, I mean, it's something I'm extremely passionate about. I understand the term prediction market is kind of the popular term for it. I think it's a little bit of a dangerous term because people think if it's below 50%, it's not going to happen. If it's above 50%, it's going to happen. That's not really how it works. It basically means, if there's a 20% chance something's going to happen, that means if you have 5 events, it's going to happen one of those times. And so I think this kind of taps into humans in general. This is why betting companies generally make so much money, and gambling companies. But humans in general have a very poor understanding of probability. It hasn't been built into our DNA. And so people's intuition about the difference between 20 and 30%, for example, is very, very poor. And so, it's very dangerous I think that word prediction and prediction market is a dangerous word because it implies the wrong thing. I sort of think about these more like the wisdom of crowds or event markets that gives you, the best, what the wisdom of crowds thinks that the chance is right now. But that doesn't mean it's correct. It doesn't mean it prognosticates the future. It's basically just a very, very good guess with diverse opinions in real time, and it gets graphed and you monetize those opinions. And so it's that the problem I've always had, after doing this for so many years, it's so hard to explain the nuance to people. I really think that event markets on political events, namely, should be a very, very important part of the discourse. But there's a long ways to go to kind of educating the world, the educating the people to use this on like what it means and how to interpret it and all those kinds of things. So we're playing around with charting and different prices and trying to use percentages to try to bring it to a wider non-betting audience. But I think that there's tremendous utility in this. I think, if you watch the news, and I'm a passionate, I watch way too much of the news. One of the main reasons I'm watching the news, and I think other people watch the news, they're trying to guess what's going to happen in the future, and basically the whole beauty of the event market or the betting market is that the betting market kind of synthesizes all that information for you. So rather than watching a CNN panel and, the Today Show Meet the Press and all these kinds of things and trying to guess who Joe Biden is going to pick as a VP candidate, you can just go to our VP market and just see what the real-time chance is. Right now, Kamala Harris is 37%, Amy Klobuchar is 15%, Gretchen Whitmer is 11%, Laura Kelly is 0.5%, Stacey Abrams is 16%. So, without having to spend an hour of your life watching Meet the Press, I can just go and say, oh, look, Kamala Harris has about a 1 in 3 chance to be vice president, and this is her chart, and her stock seems to be going up. So I really think they're incredibly useful. I'm passionate about it. It's one of the main reasons I founded the company. It's part of the reason, we don't care about the traditional sports betting model that much because, we're here for event trading. We're not here for sports gambling. And I'm really passionate about it. But we haven't found good ways to kind of bring it to a wider audience yet.
Understanding the underlying percentage and probability of something is not always well grasped, as you described.
Yeah.
Have you thought about it in terms of US odds is something that always comes up with, minus 110 versus, $1.91 or however it's displayed. Is that something you're going to potentially look at in terms of your launch here in the US and how you help educate those people that will be accessing your applications?
Well, it's funny you mentioned that. Even though as an American and even though I run a gambling company, I have no idea. I still really don't understand American odds. Every time people say minus 110, I'm like, what kind of system is that? I really don't understand the system. I think it's a ridiculous system, to be honest. But if you really want American odds, you can go to our settings and you change it to American odds and look at that. The product that we're launching in the US is going to be called SBK, which is our sportsbook product. So we're not going to be surfacing political bets on SBK in the UK. SBK bets in the US. If people want to see our political betting markets and they're based in America, they can go to smarkets.com and look at them. But Americans won't be able to bet on them until we get a CFTC license.
Is that on the agenda in the next 20 years?
Oh, yeah. But I don't know if it's year 1 or year 5, but it's certainly something I want to do. We almost did it about 2 or 3 years ago, but we decided, our company's 120 people, so we only have so many eggs in our basket. We decided to put them more on sports betting because we thought that would, pay dividends faster. Maybe I shouldn't have done that. The nice thing about the CFTC is once you get the license from them, it's nationwide. So, you can take political bets in all 50 states if you get the CFTC license, whereas sports betting is state by state. But I would say volume from sports to politics is probably 1,000 to 1. So, the money is certainly in sports.
So on SBK, what can those users in Colorado and Indiana expect as opposed to what they're used to with, the typical FanDuel, DraftKings, BetAmerica type apps?
Well, the main thing is going to be price. So in a minus 110, we haven't quite figured it out. And our pricing is dynamic, which I think is going to confuse a lot of people. But we're not going to have, we're not going to fix the price at 110 and then move the spread. Because we have a legacy in exchanges, we more have the spread and then move the price. But we're going to be trying to do something like minus 102, minus 103 for as many markets as we can. Sometimes it'll be worse, but sometimes it'll be minus 101 in some cases. So I think the biggest shock that will come to people is going to be price. The second thing which we're trying to figure out the best way to do it, but we have an inbuilt social network so that people can leave comments, share bets, taunt other people, share which accumulators they bet on, all those kinds of things. So we I think are the only ones in the industry that have our own social network that's built alongside it.
That'll be within SBK, or is that linked to the other socials?
That's within SBK.
Okay, interesting. Yeah. So sort of a chat room function type thing with multiple people to trash talk, I suppose.
Yeah, we're trying to figure it out. It's closer to Instagram where basically you can like leave posts about your bets and things. So less like real-time chat, more like posts, but we're experimenting with it all the time. We launched this product, I would say 6, 7, 8 months ago in the UK, and we've been tweaking it in the UK market, and then we'll keep tweaking it once we launch in the United States. But the first reason somebody should use us is our prices should slay the competition. I think FanDuel and DraftKings have horrible pricing, as well as the other competitors. So I think people are going to be pretty surprised at how much money the bookmaker's been making off of them once we launch.
So let's dig into pricing a little bit. Why can you offer minus 102 and those others won't? I mean, obviously they can, but they don't seem that interested in doing it except for mainly marketing and promotional purposes. And you might see every now and then plus 100 both sidelines and things like that, which are clearly from a marketing perspective.
Well, I think it's kind of the old school model in gambling, which I think will be yesteryear soon. But basically the old school model of gambling is that you make roughly 10% on the customer. Which means for every $100 they bet, you make $10 in revenue, and then you take that pretty juicy margin and then you throw it back into top line advertising and promotions. And so I haven't seen recent lifetime numbers, but in the UK, like lifetime value of a sports betting customer is say $500, give or take. So that sports betting operator in the UK is saying, okay, I'll make $500 from this person. I'm going to try to, I'm willing to pay up to $300 to acquire that customer, hopefully less, but I'm, in terms of bonuses, affiliates, marketing, all those kinds of things. And the reason why the legacy operators cannot offer better prices is because they rely on that kind of marketing hamster wheel that they're kind of stuck on. And so if they had smaller margins, they wouldn't be able to fund all the marketing stuff that they do. That's essentially it. The other thing is, in general, I think most bookmakers are not very good at pricing markets. Most bookmakers are generally marketing companies that sort of have a little bookmaking operation on the side to monetize it. So like FanDuel and DraftKings, I'm pretty sure that they don't even run their own books. I think that FanDuel and DraftKings outsource the risk of their books, or even if they don't outsource all of it, they will outsource a lot of it. I think DraftKings outsources it to Kambi. So some guys sitting in Europe are deciding the risk for all the bettors in America. So it's just such a very backwards, outsourced, kind of old school way to do sports betting, where we price things. We have a real-time exchange in Europe, which basically prices the best odds in the world, and we're able to take that technology and then apply it to the American market, which is it's kind of like I don't know, Blockbuster to Netflix, I guess. That kind of like we've just taken techniques from finance, modern trading, all those kinds of things, modern technology, and applied it to sports betting, whereas basically none of our competitors have done that.
How do you rank the most important aspect for gaining market share between price, which we've talked about, and the technology? Because I'm guessing there's potentially some competition between those two, and you've got to figure out where you allocate resources and time and efforts, and maybe you can't have all on both.
Yeah, I mean, that's kind of where I spend a lot of my day today. If I'm not trying to satisfy some esoteric requirement for American regulation, I spend a lot of my time trying to debate between, which product goes here, what's the trade-off and all that kind of stuff. So I don't know. It's like 2/3 of our company is technical. That's one of the main things that we do, is to try to make sure that we make that trade-off. But I would say, just to change the premise of your question a little bit, it's a lot more, technology is the catalyst that lets you make the pricing good. So it's not always a trade-off in terms of like, do you have worse technology or worse pricing? So like the technology dovetails with the pricing so that you can streamline things. So just to give you an example, like we automate almost everything in our business, whereas I think a lot of sports betting companies still have quite manual processes, whether it's fraud management or event management or customer service. A lot of these things that most companies will throw bodies at, we throw technology at. So we certainly still have manual stuff from time to time, but I would say, out of 100 operations, like one is a human operation and 99 are dealt with by the computer. So the computer lets us have lower overhead, lower costs. So we don't, going back to that marketing hamster wheel that our competitors are kind of caught up in, we are able to, our cost base is tiny compared to all of our competitors. I think DraftKings, I don't know if Betfair or Flutter breaks out FanDuel's costs. But I think DraftKings said they lost $81 million last year, something like that. Is that number right? Does that sound right?
I'm guessing they would call it an investment.
Well, sure, but they whatever.
Yeah, no, I think it's
I can invest
amounts
$81 million too if you want me to.
Substantial amounts of capital being allocated to future markets, future customers, I suppose, and marketing spend and all those other things. And I think even recently the New Jersey numbers came out for March, and almost all the books lost in that month in terms of gross gaming revenue, just basically, bets taken and the results of those bets not factoring in all the other business costs. So it is an interesting market at the moment across the US.
Yeah, well, I think the fundamental problem is most of the people in the industry have built their businesses they're very top heavy and very, the technology is outsourced and they're very expensive and they rely on marketing and all these kinds of things. And I think it's going to make them very unnimble or not nimble to respond to market conditions. So I don't know. I mean, who knows if I'm right? Like, this is just my theory. This is just my business thesis. But my business thesis is that people want the best odds. They want a great app. They want an amazing experience. And I think we're better placed to do that than any other betting company in the world. So I could be wrong, and people could not like good pricing, and they might want the bells and whistles of a more quote unquote legacy or traditional operator. But I think people, once you see 102, why would you ever want to bet at 110 again? To me, it just seems crazy.
It really does. And within that, tell us a little bit about, match betting, arbitrage, and these type of things. Let's just say Colorado, let's say goes live in a couple of weeks on schedule, and then we have a pretty robust sports betting market. You're offering minus 102 on a lot of your events, and obviously the competitors are following their own business model. Play out that scenario for us as prices hopefully generally get tighter and those match betting options become available. Is that something that you've thought through?
Are you talking about Russian table tennis? Is that my 102 on Russian table tennis?
You might have to start with NFL and go from there.
You think NFL is going to start in time? I don't know.
I doubt it, but I'm a bit of a pessimist, so I hope so. But
yeah,
there's still enough time. I think we kind of feel like it's September already, but
September feels like 4 years away to me right now.
It's still March, I guess, or April, or whatever it is, and then it's all a blend.
So the thing about match betting or arbitrage, going back to your question, is that you can do it anytime. Basically, you need a buy leg and a sell leg. So the better our prices are, the more you should be able to find promotions or mispricings that people should be able to arbitrage. So certainly basically in order for arbitrage to be profitable, you need inefficient and bad pricing. So a lot of the arbitrage opportunities will be more up to our competitors to see how sharp and fast they update their prices. Because we're attached to an exchange and, we have all that kind of, we handle hundreds, if not thousands of bets per second across our infrastructure. We are geared up to change, in some cases, prices change multiple times per second. Most bookmakers, I would say, well, I don't know what their underlying systems are, but I think a lot of bookmakers aren't equipped to change prices that fast. So we'll see if they're able to kind of keep up, but the amount that you can arbitrage is basically dependent on, I don't know how bad the pricing is on other venues. So we'll have to see, but I'm sure there'll be opportunities, and certainly a lot of companies do loss leading bets, and you can arb those, and then get your money back kind of promotions, you can arb those. So any of those promotions will certainly help our customers arb those promotions.
Where does the pressure go in that instance? Does it all go towards the soft books or the traditional models, or does it somehow end up being okay with a lot of arbitrage going on, match betting going on? Because it seems like that's a bit of leakage from what those typical models of sports betting would encounter.
In Europe, the bookmakers are making so much money, they're okay with a little bit of leakage or breakage, just because they're monetizing so much. Now, we've been so successful in Europe of creating arbitrage opportunities to the tune, I would say, like a 50 million pounds in the last couple of years. And so operators have certainly taken notice, and they've taken actions against customers that are doing it. So customers have to be more and more savvy about masking their activity so that they don't look like they're arbitraging or match betting. But bookmakers kind of tolerate it for a few reasons. But the main reason is they still will make money overall on the promotion. So they might make, I'm making a number up, but like let's say they lose $1 million to arbing, but they make $9 million on the promotion. They're like, it's still a good idea. So, for everybody that arbs, there's going to be like 10, 20 people that don't arb. So they'll still make money on it. So it depends on the operator and how aggressive they want the promotion to be. But the more aggressive, the easier it is for a customer to arb it.
Isn't it not cheaper and easier for the bookmaker to just get better? Or is that not a viable option for them for technology and other reasons?
It's not really how they're built. Like especially if you're outsourcing your technology, a lot of the risk these days is outsourced. So, like Canby is one of the big B2B providers in sports betting. They do their own trading desk, and some, like I said, I'm not sure where they sit. I know they have an office in Sweden, but I don't know where the traders might be in Sweden. And I think in the case of SBK, it's in Bulgaria. So like, if you're betting in New Jersey, your bet is going to some risk desk in Sweden or Bulgaria. And those are the 6, 7, 8, 9, 10% margin business models. Those aren't the let's see how tight we can get it. Those models are around, I want it as wide as possible and people will still bet kind of models. So that these companies aren't really geared up to be doing low margin betting because they require the big margins to fund their operations.
Just one final question on this point. Do you have any expectation that the US customers that you'll encounter and acquire will be any different to like those in the UK or anywhere else where you're operating?
To be honest, I'm really curious about it. I think there's two competing factors, which I'm interested to see how it shakes out. One, I think the American consumer, especially compared to the European consumer, is more tech savvy and more consumer savvy. I feel like Americans are quicker to adopt new technology. And, we're used to a lot of the big consumer internet companies are out of America. So we're kind of used to new things, new brands, trying new things. But at the same time, the American betting consumer is used to such backwards technology, like these Caribbean sports books and like the Europeans, the American sports books that are online. They're very poor experiences compared to what you can do in the UK. And so I'm kind of curious how those two ideas collide. So, but my guess is the American consumer, once they realize there's better experiences and better prices, they will flock to that. And I think American consumers care less about brand than a lot of people think that they do. And, just like, Facebook was an unknown brand, Instagram's an unknown brand, TikTok was unknown, Snapchat was unknown. I don't think Americans care that much about unknown brands. So I don't think like the name FanDuel, DraftKings matters that much once people find a product they like better. So I think American customers will switch more, and I think the American betting consumer, which is used to old technology, will get educated faster. But we'll see. Who knows?
So on the US market, liquidity-wise, obviously you mentioned earlier, you've got to think of it as country by country here in the US, and just the way the bets are processed and made. Obviously, I've heard you talk about them. They're obviously fungible, and thinking about it from a more broad perspective, though, whether it's SBK now in Colorado and Indiana, or thinking ahead with your CFTC license and potentially an exchange down the line, if things don't change drastically on that front, how do you think about the overall liquidity, the overall risk management? And are there, I guess, processes in place that you're thinking about in order to manage that properly, just given all the different requirements here?
Well, I think because of that fungible product, you can kind of look at risk on a on a pan country basis, to use that metaphor. And so risk, I assume you're talking about absolute risk, that you have like 300K exposure to the Patriots at this time, or those kinds of things. So risk is kind of you can abstract the country metaphor away and kind of look at risk on a pan country basis and make decisions based on that. But in general, betting, I used to be a trader, and it must have been like the first week, but my boss at the time basically said the only thing that matters is price when you're trading. And so really when it comes down to betting, even if you're on the bookmaker side or the customer side, every bet is worth taking at the right price. And so in general, the bigger issue in betting is what is the right price to take this bet at, not what is your aggregate risk. If you're taking things at a good price, you'll make money over time. The thing about increasing your risk to high levels is your volatility goes up a lot. So of course, if you take a good bet at a good price for $1 million of exposure, that is going to change your balance a lot more than, $1 million $1 bets. So you want to be careful about the volatility, but if you have the cash to ride at the volatility is not the most important thing. It's more, what is the right price for, the Patriots to beat Tampa. And so that's more of the art rather than the aggregate risk.
So I want to ask more generally about commissions and where they're headed generally in the industry, not necessarily any particular region or jurisdiction, because I think in some places they're going up, in other places they're stagnant, and obviously many traders would like them to go down. What's the general trend line for commissions at this point?
Well, I mean, I think in general, most markets, outside of betting, generally things get cheaper, faster, better over time. And I think sports betting should be no different. The problem in America is there's tons of hidden costs that we have to pay that the consumer has no idea about. The leagues are charging tons of money for sports data. Taxes are very high. And so the biggest limiting factor, I think, is going to be the regulatory frame. The expense of the regulation is enormous in America. With that will be our biggest impediment to providing good prices for the customer. But in general, barring that, I think in general things will always get cheaper, faster, better. And so whether we do it or another company does it, I do believe that somebody's going to come in and disrupt sports betting as we know it, in this 7-8% model is going to go out the window. We're going to live in a 1-2% world. I definitely think that's going to happen in the next 5 years.
So you mentioned Hanson last time we spoke, and just some more details around it, if you don't mind, about why you started it out, why you don't let market makers do that, and what the plan is moving forward, and if it's going in the right direction now, what that looks like.
Yeah, so basically when I started the company, I was really interested in event markets in general, and I saw Betfair and a few other companies, and I thought that the interfaces and technology were poor. And I never really wanted to be in the risk business. I always wanted to be in the exchange, the pure exchange business, and to let people trade against each other and not have to take any risk. The problem is with exchanges, which I found out the hard way, is that liquidity is really, really important, and there are not enough institutions to provide liquidity. So I created Hanson as our own company to provide liquidity. So basically, I think it's hard to verify this, but I think Hanson's the world's largest sports market maker right now. We trade hundreds of millions of dollars worth of sports bets a month, or at least before the crisis we did. And basically Hanson is our own trading desk that sits is a major customer of our exchange. We traditional traders that trade on our exchange, and compete against Hanson. And sometimes Hanson wins, sometimes Hanson loses. But basically Hanson's our own sports trading hedge fund, if you like, and that's what we use for global pricing. And
is it a customer with other exchanges? Is it something that is kind of isolated and run independently?
Yes. No. Yeah. It does run sort of independently. It's becoming, the bigger it gets, the more independent it's becoming. And it does trade on other exchanges. Yes.
And is the trajectory add more people, add more skill set, add more trading liquidity around the world?
Yes.
Okay. Interesting. Yeah. I wanted to ask about API integration as well, and certainly for the professionals out there that like talking about topics like this and like talking about ways to get advantages. How is it? I think last time you said it takes some time for people to get integrated, and obviously the everyday punter and everyday bettor can't necessarily call you up and get integrated tomorrow, or maybe that's changed. But what advantage or value does it have for the sports bettors?
To have API access?
Yeah.
Oh, I mean, if you want to trade in any kind of systemic way, you have to have API access, or be very, very good with a keyboard, mouse, or grease monkey or something. But you basically you want API access. If you want to do over one bet an hour, you kind of need not an hour, but if you don't want to have to rely on your mouse and your browser to place bets, you need API access. So it's basically, for those of you that don't know, API is a way for your computer to plug into our exchange so that you can place orders with a computer. And if you want to be serious on a significant level, you have to use an API. You can't, it's too inefficient to do it manually.
Does it become more mainstream at any point, or at least a hidden API version where those people who may not be professional, may not be full-time even, but can set certain things up through pretty off-the-shelf tools to be able to execute some of those things?
There are those tools, but if you're the kind of person that doesn't, I don't know. I don't think it's something I would necessarily dabble in. I would kind of like, if you want to do an API for sports betting, I would learn the techniques and get serious about it. It's not really designed for people to kind of dabble with it. It's more like if you want to dabble, you should just trade manually and get a feel for it that way. And if you want to decide you want to take it to the next level, you probably need to go find a computer software engineer that can help you code whatever you want to code, whatever your algorithm is. Like I want to buy here, sell here under these circumstances, those kinds of things. So at some point you have to, if you do want to use an API, I do think you should at some point involve a software engineer. It's not really something to dabble with. Now there is third-party software. We don't integrate with them, but there's third-party software that sits on Betfair and the other exchanges that kind of let you automate triggers. So it's kind of a way to plug into an API and not have to do with it. But I never really, that kind of like middle ground never really interests me that much. To me, it's like if you're a hobbyist, you should use the web, and if you're serious, you should use, by serious I mean institutional or professional, you should use an API.
So thinking ahead for those people, institutional, professionals, and let's just say your business model is adopted and is the norm in the US, and we're 2030, we're out of a pandemic for 10 years, everyone's happy and healthy, and Chicago and New York and these places are going to have funds set up purely to trade sports. In that world, does it look like what trading looks like and what the movies show, and then how all that looks today with finance?
I think so, but I think it'll be more akin to like an exotic commodity rather than like stocks. So like the stock market, I don't know what the exact volume is, but like say the stock market trades billions, if not trillions a day. The problem with event trading is it's a zero-sum game, and so and things turn over very quickly. So for every dollar made, a dollar has to be lost. And so in sports betting, if you want to look 10, 20 years down the future, it will never be bigger than like the stock market, which kind of encapsulates a huge percentage of our economic output. But I think I think it would be more akin to like, people trade the weather, for example. Like there's weather contracts and natural gas contracts and, like copper contracts. I think it'll trade more like that, where there'll be small desks on big investment banks, but I think that there will be trading desks. But yeah, I would think about it more like a small exotic commodity rather than Wolf of Wall Street.
Is that bad for the average sports bettor, just given it is zero sum and we're going to have these incredibly smart funds and institutional involvement in the industry?
Well, it's a double-sided coin in the sense that the inefficiencies in the market will be harder and harder to find. But that said, your vanilla price that you're going to bet on sport is going to be much lower margin. So I think for 99 out of 100 bettors, it's a better thing. But if you make all your money, if you're a professional bettor and you're relying on a 3, 4, 5% inefficiency in the market to make money, I don't think that's going to exist anymore. But if you're a casual bettor, I think you're definitely going to win. Just like, I think I've used the stock exchange world, now Robinhood lets you do Charles Schwab lets you do free trades. Back in the day, it used to cost $100 to do a trade. Now it's free. So I think in general, the end consumer is going to be the big winner. The professionals that rely on the short-term inefficiencies that exist now, I don't think those will exist in 5-10 years. But that said, the more liquid the market gets and the bigger the liquidity gets, that creates new opportunities as well.
What type of tools and features do those professional traders need in that instance? They're obviously going to be very different to what's available today and what the average sports bettor wants, but are they going to be very similar to what tools they need to operate their hedge fund now?
Yeah, I mean, you can oversimplify it to, like, in the financial world, there's two things that really matter. It's math and speed. And I think that's what's going to matter in sports betting. It's math and speed. So the better your math and the faster you are, the better you'll do. And the reverse is also, is not the case. Like, if you have bad math and you're slow, you're not going to do well. So it's as simple and as complicated as that, I guess. You need to have a model that predicts what the right price is so that you know when to trade. And once your model says this is the right price, you trade faster than anybody else, just like traditional finance.
How does the fairness aspect come into play? Obviously, speed is critical, and in finance, any of those movies you watch about, getting the cables underground from Kansas to New York or whatever it was, or all the high frequency stuff, it's all, micro milliseconds type stuff.
Yeah.
And same now, even with things like, TV broadcasts, when it's delayed by a few seconds or things like that, people always seem to be frustrated and upset about that. Have you thought about how that world's going to evolve, or even now? Like, how do you deal with some of those things now that you have to address in the short term?
So in terms of like delayed TV feeds and stuff like that, we try to normalize that with the terminology we use is called managing our markets, which means we add artificial rules to the trading on our market to try to disadvantage short-term time advantages. And sometimes it works and sometimes it doesn't. But like in soccer, we have the most advanced rules where basically we have something called instant match, where we match your bet right away, but it goes into a pending state. So if something happens while it's in a pending state, like a material event happens while it's in a pending state, we'll void your bet. And so the whole point of that is if somebody knows that a goal has happened before anybody else, the system is designed to eliminate that advantage. In most sports, outside of soccer, we add a vanilla delay such that we think that the market will be up to speed within 8 seconds, 9 seconds, 10 seconds. But I think as the industry matures, that those rules need to get more sophisticated. What a lot of the leagues are starting to do now is they're trying to monetize sports betting by selling really fast data. And so tennis has been a very classic example of it's called court sighting, which is basically you're sitting at the tennis match and you hit a button on, in your mobile phone in your pants that say like the serve was a fault or something, and that the mothership bets on an exchange before anybody else knows it. Now, the tennis leagues are trying to sell their data so that the umpire, as soon as the umpire presses that button, that goes to the betting companies within milliseconds. So some of the ways to solve it are with better, faster data feeds, and some other ways are like you add more delays or you randomize matching or stuff like that. But that's one of the issues in terms of like microwaves and Kansas City to blah, 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 those kinds of things. I think the industry is probably 10, 20 years away from those kinds of games. We're still we're very much in the realm of second latency era, whereas, finance is like microseconds. So it's a world of difference, but we're certainly in the seconds latency world. So we're pretty far away from microwave towers and underground cables and fiber optics and all this kind of stuff. But it will get here eventually. And I think as the market gets more sophisticated, the rules to manage these markets will also get more sophisticated.
Is this stuff by choice? Like, do you guys sit in the office and get the smartest people together and figure out how to approach it? Or is this in the regulation? Because I'm sure regulators have no idea about most of this stuff. And obviously with the US market evolving, it might be, or it sounds like it's probably on the operators to figure out this stuff and then adopt whatever they think is most fair.
Yeah, we get people in a room and we debate it. So it's more of an art than a science, because the data that we get is not very high quality in most cases. Of soccer's the best, and it'll be on a case by case basis. It hasn't been that big of a deal in American sports because historically American sports bettors didn't bet in play. So they didn't need to have these rules for in-play betting. In Europe, for most American sports, we just put a vanilla delay on it, which I think covers you 98% of the time. But I think it's more interesting if you allow people to match their bet instantly. I find it, as a consumer, I find it very frustrating that my bet goes into a queue when I want to bet live. But it also requires more sophistication of data and more sophistication of rules in order to do that. So like, if you're trading live, and somebody's about to throw a Hail Mary pass, and like, do you stop betting? Do you void the bet if it's caught? Do you have a delay? Like, there's many different ways to skin the cat, and it's not always straightforward. So it is a complicated problem that has complicated edge cases.
Couple of quick ones for you to finish off. I see that Tennessee seem like they're about to approve a minimum hold percentage, and it looks like it'll be 10%. So basically, you've got to have 10% hold at the end of the year. Just off the top of your head, throwing stuff against the wall, what does, if you had to go to Tennessee and you had to operate SBK and you had to do all these things, how do you address that question?
I think it's absolute madness. I just saw the headline for that, and I shook my head vigorously. It's really one of the stupidest ideas that you can have. So I was trying to think of ways around it. So one, you could have a 10% VIG market that prices contract A this way, and then you can have another market that prices contract B another way. So like each market independent of each other has a hold of 10%, but independently you have the proper price. So I don't know how they're going to enforce it. And I haven't been involved in Tennessee. I mean, if that's the rule, we'll abide by it, and complain about it loudly. But I get really frustrated at my country that we have so many smart people in this country, and our laws just are so backwards sometimes. Like the UK law has all of these issues figured out. In the UK, we pay all of our taxes. It's very competitive. Anybody can participate. It's not some closed door cabal that casino owners get to participate in. And it's just insane to me that all these regulators that don't know what they're doing just try to keep reinventing the wheel. So it's a horrible, horrible idea. Shame on Tennessee for proposing it. But I hope that they see the error of their ways and fix it.
So one final one, and I think you've touched on this in the past in terms of being a tech-led company, founder-led. Just tell us a little bit about the benefits of that over the longer term. And I think we've discussed some of the downsides of potentially the traditional model versus what you expect in the future, but just versus a publicly traded company or a more professional CEO and how they approach these types of questions and problems.
Well, I think you can run into the trap of like the founder is bad at what they do, which is, it could be the case in my case, but I think it could be me. But I think the big benefit that a founder gets is the political capital to make big changes. So if you're a professional CEO, like for example, Peter Jackson at Flutter, he's relatively new to the industry. Like he doesn't have the political capital to go do bold changes within the company. There's too many people that work there, too many shareholders, too many board members. And so you're kind of hamstrung, like even though you're CEO and people think you have lots of power, you're kind of hamstrung by the momentum of the company. It's really, really hard to change tact of the company. But the nice thing, if you have good, as a founder CEO, if you have good relations with everybody, people will trust bold changes a lot. Well, I would say they trust bold changes, whereas in a big publicly traded company, they wouldn't. So say, for example, we wanted to make boats. We wanted to go into the shipping industry and start making boats. This is crazy, for instance, but like I would have a fighting chance of implementing that, whereas a public CEO of Flutter would have no chance of doing that. So that's the main benefit, that you can make harder, stronger, faster, bolder changes than you can if you're a publicly traded company.
Jason, it's been a pleasure chatting with you again. I appreciate the time. Good luck in Colorado and Indiana and all the other states that you enter, and hopefully we can bet on politics through Smarkets pretty soon, and hopefully the world is your oyster when it comes to dominating the US.
Thank you so much for having me on. This is one of my favorite podcasts, so I really appreciate you having me back on.